Please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Hello and welcome to Taking Stock, the show where we take stock of the week gone by on Dalal Street and of course also prepare you for the one that is about to come. I'm Surabhi Upadhyay and with me is Lata Venkatesh. Interesting week, plenty of news, plenty of cues. At the end of it all, about a 1% up move on the benchmark indices. Lata, what did you think? And I mean, the sectors that you track, banking, the bond market, that's where a lot of the volatility and the headlines are coming from.
All the negative news came. Well, actually, the positivity, I think, was global as well. And, you know, try as we might, despite all our uniqueness, we will beat with the global rhythm. And there were very good earnings, Goldman Sachs, Netflix, what have you, in the global space. And that kept the US markets up 1%. And we were up, I guess, 0.8 or thereabouts. And we also had a bunch of good earnings. IT earnings, of course, were excellent. TCS, Mindtree, Cyient. But even IndusInd, the non-IT earnings also, the few that have come so far, have been positive. There was good monsoon cheer as well. Actually, considering all this, I thought the rally was not good enough. That's because I think that 10,600, 10,550 to 600 is proving to be a very good resisting mark. Metals were very much a positive factor for the markets this week. So metals and IT were anyway there. Earnings were there to cheer the market. I think what let down were the banks. Bond yields higher for various reasons, and some strict speaking coming in from the RBI Deputy Governor also kept banks a little under the weather, as it were.
Absolutely. Well, the jury's still out on that one, I guess, because the government does want a bit of a dilution and pushback. We will be discussing this and a lot more with our guests on the show. Joining us to talk about the market is Ajay Srivastava of Dimensions Corporate Finance Service. Thank you, Ajay, for joining us. Always a pleasure having you on the show. So, you know, it depends on which way you cut it, whether you're an optimist or a pessimist. Given that the market has weathered crude prices, bonds, etc., would you look at it sort of a glass half full? Or would you say half empty? Because as Lata mentioned, you know, there was a monsoon cheer, decent earnings, and we couldn't break 10,600.
You know, I would say that this is a beautiful time in the market when people are shifting around the portfolios and new sectors are emerging. If you look at this week, Surabhi, one of the things which came out very clearly was the long badgered sector called the hotels. They saw a big revival. Of course, IT today saw the biggest revival possible that you could ever imagine in IT sector. A 7.5% increase was unimaginable for a company like TCS. So I think, you know, you would take a mixed bag out of this to say that some of the forgotten sectors were one which took the traction this week. Some of the most owned sectors are the one which took a beating. And I think the lesson here is one bit, that, you know, we are going through bouts of euphoria, bouts of pessimism at this point of time. I think 10 days back, Lata was on the show when the credit policy was announced, the yields dropped dramatically. The photo play was brilliant, and the yields are back to where they started. You know, so what we are seeing also is that a lot of dramatic events take place and then we go back to square one. The nationalized bank rose up and they promptly fell again back to below what they were on the day of the credit policy. So, you know, so when I say half full or half empty, depending on what kind of portfolio you got. If you got money, you moved your portfolio around, it was a full glass, absolute full glass, because IT just gave you spectacular. Hotels re-rating was spectacular. And of course, if you were the old sort, we thought buying PSU banks and PSU oil companies were the greatest thing to do in this country, you took a big knocking on your portfolio. So I think roughly speaking, it's the very clear demarcation in the market. One is that the PSU stocks by and large are not working for anybody. For whatever reason, one may say, whether banking, commodities, coal, oil marketing companies, engineering companies, PSU block has not performing, it's not doing anything at all. The number two is that the big problem in the market is the mutual fund industry. They are calling it all wrong. Their portfolios are going wrong, completely haywire. If I tell you, you'll be surprised. TCS does not exist in a portfolio of one of the biggest IT fund today, that mutual fund. It doesn't exist there, TCS, which is a re-rating. So we are going to see a dichotomy between what market is doing and mutual fund is doing, where actually most people are invested. So it's a very funny kind of situation where I think even experts are not able to tell what to place the bets on.
Okay. Well, that's beautifully put, all the contradictions and paradoxes in the market, Ajay. But from a lay investor's point of view, the advice always is don't buy markets, buy good stocks. Yes. But still, I want a final question on the market. Do you think that the earnings will be good enough, the momentum, the tailwind of earnings and global positivity to take us beyond this 10,600 sometime soon?
I think so. And I think so, the reason being that I think if we have some of these nascent sectors getting buoyant, you will see cement taking it up, you will see private sector banks after a hiatus will kind of come back into the reckoning. So you will see the index stock at least starting to perform better, and which runs with the theory that in this kind of an economy, you have to stick to the market leaders. If you look at it, the most obvious ones are performing, and the most obvious ones constitute a Nifty or BSE Sensex. So stick to if you're sticking to the leadership, which I believe is the right strategy in this market, I think 10,600 is par for the course post the results as we go along, because cement companies are going to give us good results by and large, and I think after a little bit of raving and ranting, you'll buy private sector bank. L&T might surprise you a little on the upside. Oil companies have already taken the hit, so nothing much to expect from them. Pharma is already in the dump, so anything in a positive can come in. So I think this index of 200 points that we are worried about, I think we will cross that hump in this earnings season.
Okay, Ajay, another sort of, defining trend of the week was that everybody wants to own consumption stocks in whichever way, staples, liquor, milk, it doesn't matter. Is that becoming too simplistic a theme or an idea now? And how would you approach consumption?
Well, look at this way. It's an expensive idea because the valuations are not cheap of any stock whatsoever. So that's one. The problem is it was least owned by most people and the most sectors because it's considered to be the low glamour end of this market. Yes, it's now getting into a problem area that you're buying at very expensive valuation. But where do you go in this market? If you look at it in the consumption story, if you look at the bank credit, what the data came out today, that almost 100% of incremental bank credit went to retail finance. And that tells you the story that what stock you should bank upon, which means that it's consumption story playing out, not the industrial story. So you can't help but not buy it. And it gives you corrections. If you look at Bata, you look at other stocks, you look at Britannia, you look at Venky's, they all give you corrections to enter into. I think this saga is going to continue. I think they are on a good wicket. For next 1 year or so, they should do much better than the market. Zero debt companies, no interest rate risk, and by and large, they're not facing competition. That's the best part. There are no MSMEs now nibbling at them or giving up price cuts and so on and so forth. So they're getting shelf space by the dozen. So I think the theme is good. You will keep buying into it. Wait, don't have to buy every time on everything on the top. You can wait, and this market gives you enough time to buy. But consumption is for here to play. And the number of stories, if you look at holiday resort companies, they are doing well. You saw this hotel company, Lemon Tree, did fantastically well after a absolutely horrible IPO, which is what a surprise. That's why I say, where are the experts? You have a horrible IPO, within 1 week, the stock has given you 25% returns. It kind of bothers me that why none of us are able to pick out these trends. So I think consumption story is there, and it gives you so many more choices. You got cinema companies, you got liquor companies, you got a footwear company. So so we also have a lot of choices there, unlike in a bank where after you buy HDFC and Kotak and you say, now what?
That's a fair point.
That's a fair point. Okay, I like the way you put liquor and milk one after the other.
Because it's a fact. Radico Khaitan about 15% this week. Parag Milk up 23% this week. So you can take your pick.
It's just that they're the most likely things together, aren't they? Okay, Ajay, but hotels can still be bought?
Of course, yes. I think hotel, the story has started. The first flush of the money has been made by investors who were smart enough to be there. But I think this is a story which is now a next 12-month story is going to come together. And I think the reason being very clear, it's under-owned, it is underpriced at this point of time, real estate has gone up expensive, you can't get supply easily, and it's consolidating as chains whatsoever. So competition is also coming down, rack rates are moving up. Domestic travel moving up means hotel will eventually move up. So again, the consumption story, the airlines have done remarkably well, will do it, and that whole thrust will come onto the airlines, whether it is eating out or living in or holidays or etc. Hotel industry is still a buy in our view.
Okay, so eating out, holidaying, going to hotels, that's what we wish you this weekend. Have a great weekend, and thank you for joining us. Ajay Srivastava.
Thank you very much, Lata. Thank you very much.
All right, let's take a break on that note. But meanwhile, we'll also leave you with some market opinion that we heard through the week. When we come back, Ashwani Gujral will be joining in to answer all your stock questions and give us some technical advice for the week ahead.
One thing which is very clear in my mind, that volatility which was really missing in markets for the last 2 years, that is back for sure. So you will have a lot of volatility in this year and maybe coming into even next year. So that, and to my mind, that is the only real hope and opportunity to make money. Because in the markets which just keeps going up, when the valuations become so unaffordable, there are not too many opportunities. So investors will have to set up their mind that this volatility is here to stay.
Generally speaking, in the space that we're in, the emerging markets, the growth is still holding up very, very good. China and India going at 6-7% growth. Now Brazil has recovered very nicely. Of course, they're still going through the Lavo Jato scandal, but the reforms taking place are really very earth-shaking. So I would say we still got a few innings left.
In many fields, right from automobiles, four-wheelers, as well as two-wheelers, as well as commercial vehicles, consequently auto components, commercial vehicles, consumer durables, consumer staples, discretionary consumption, chemicals and specialty chemicals, affordable housing, cement, even steel. These are all the sectors which are witnessing a demand burst. So while there is worry on the oil price and consequently on current account deficit, and if price burden is not passed on to consumer, then from fiscal deficit point of view, overall micro momentum is pretty good.
We are in a longer term 3 to 4 year bull market, and yes, there will be corrections, and these have classic patterns really. We break 10,000, psychologically important level. Everyone's talking of 8,000. 200-day DMA gets broken, so all the technical analysts are coming out with 7,000 targets and things like that. And what the market does is totally different. In fact, it's recovered half the fall. It's 5% higher, yet there's nobody who's bullish. So the index taking out 10,600, which is very near, would be the ending of this kind of correction.
Understanding that we've got elections next month, which will obviously make the markets volatile. But the 2-year Treasury in the US and the 10-year Treasury in the US, so, that differential is only 50 basis points, and whenever you see an inverted yield, usually means that we're heading for difficult times. RBI kind of Goldilocks scenario for the Indian economy of strong growth, no inflation, just doesn't wear well with me. And I think the risk to their kind of targets and inflation is on the high side, rather than I expect them to be to get to those kind of figures.
Now it's time to talk technicals. We have Ashwani Gujral joining in with his view on the market. Ashwani, it was a very nice, interesting fight between the bulls and the bears. There was IT on one end, consumption IT on one side, and the banks that continue to sulk on the other. What did you make of the week's action?
See, we didn't go down, and that is a positive in a correction. Because you are flat, that shows the strength of the market. In a relatively weaker market, you would have declined towards 10,350, 400. But we've maintained almost at the highs, for whatever reason, because of IT, etc. So despite negative news, we are moving flat. Now, that would indicate that sooner or later, we will move on the upside. And despite whatever headwinds are there, chances are the market should move higher from here. This narrow range will resolve on the upside. Let's see why and how it will resolve. Maybe HDFC Bank will help a bit. But overall, the market action has been positive. Banks have not declined the way you may have anticipated. And hence, anything that takes bad news well is probably a strong sector. Within the individual sectors, IT is likely to outperform. Meanwhile, PSU banks are still, they will continue to lag. But overall, the market looks stable, and consumption, etc., will provide the extra upside.
Okay. Well, Ashwini, what hereafter? If you have to trade the Nifty itself or the Nifty Bank, how would you, and which stocks?
See, the best index to trade for a while, because today IT index is at all-time high, is to keep buying the IT index on all declines. Now, in case the Nifty, because of certain HDFC numbers, etc., has a gap up above, say, 10,620, that would be a buy. Don't try to buy it around 10,600 because every other day it will collapse back to 10,500, 520. So Nifty is a bullish call. If you get declines, try to buy it because there are enough legs. IT is there, consumption is there. On banks, I think you need to cross 25, 400, 450 decisively before you can get on the buy side. As far as individual stocks are concerned, Tech Mahindra is a buy with a stop of 690, target of 725. NIT Tech is a buy with a stop of 980, target of 1015. And Bata is a fresh breakout. That's a buy with a stop of 795, target of 830. Now, people may say that these things have gone up. They are coming out of a bear market from underweight positions, and that's where people are going to increase their weightages. So this is the time to get on to tech once the first good news is out, because often when a sector turns, there are many quarters of better news ahead.
Okay.
No, that's
well,
possible. Actually, Ajay was just telling us that there have been IT sector funds without TCS.
without TCS, exactly. So a lot of that would perhaps have to change or is changing as we speak. Okay, Ashwani, we also have a couple of questions, Twitter questions for you. So this is Prabir Mukherjee. His question is on Vardhaman Textiles. Not sure if you track this stock or not. He has 20 shares, price is 750 rupees. In case you've had a look at this chart, if you could offer any advice?
Well, he's lucky to be making money, but recently it hasn't done much. In fact, it has declined from 1550 down to 1150. So maybe, hold it with a 1120, 1130 type of stop, and maybe if it gets back towards 1150, he should look to exit because the stock is now sideways. It had a large rally from 300 to 1500 and now basically correcting. As long as 1100, 1120 holds on, he can hold on and maybe look for targets of 1500.
Okay. Well, the next viewer query is from M. Prashant. He's tweeted to us that he has 100 shares of Amara Raja batteries, which he purchased at 797 rupees a piece. He's looking for a profit of around 10,000 rupees. He says he's a short-term investor. What would your advice be?
So that means he's looking for 100 bucks.
Yeah. I know it can't be. He's looking for a profit of 10,000.
Yeah, 100 into 100 is 10,000.
Okay.
That he can get easily. I think he's halfway almost there. It's not the best auto ancillary, not the best auto-related stock, but it's above its 200-day moving average, slowly trying to build higher support. So, 920 to 940 is easily possible. But if I were him, I would tend to get into something like an Escorts, which is at all-time high, rural focus, etc., etc. Maybe Ashok Leyland, which is again making new highs. This is kind of a slow mover.
Okay. All right. So maybe you'd want to think of switching away from Amara Raja. That's the advice coming in. Nadeem's question next. He is holding 9 shares in Tata Steel. Price is 626. Wants to know hold or sell. Unfortunately, we don't have a view. We don't know if he's just trading or if this is, he's holding it for the longer term. But what do the charts say on Tata Steel now, Ashwani?
It's had a big correction below its 200-day moving average. Today was not such a good day. So first of all, assuming he's trading, don't let the stock go below 550. And as long as 550 holds on, maybe it gets above the 200, which is 630, and he can have some upside. But 630 is something which is going to be difficult to crack because it's a fairly stiff resistance. So maintain a stop of 550. If it does that, then it's back to fresh highs. But unless we get past 630, it'll be tough going for Tata Steel.
Okay. The next question, I believe, is on Bell. Harish has tweeted to us that he has 300 shares of Bharat Electronics. He bought them at 150 rupees a piece. He wants to know if the stock has reached its bottom. He wishes to add more from a 2 to 3 year perspective. He's asking if this is a good time.
Well, it's been in a plunging kind of a market. I think it should find support around 125 because that's where a previous congestion is lying. But the way it's falling, somebody is getting out lock, stock and barrel. So think about it before you add. A good way of adding is once the stock crosses your purchase price so that you know that it's going up. Averaging down to zero isn't the best strategy. So I would say once it gets back above your price, and only then add once there's a confirmed uptrend and there's good news flow surrounding the stock.
Ashwani, well, now here's my question. One of the newsmakers in this week obviously has been the rupee. It's weakened to a 13-month low at 66.05, 06 thereabouts. Has it fallen enough, or do you think there's more to come?
See, today I heard this theory that since Saudi Aramco is going for IPO in 2019, so all these guys, Russia, US, Saudis, they'll keep the oil price high. Now, if that remains the case, crude looks like it'll get to 80. So where can the rupee go? I think easily, 67, 50, 68 is possible. So that way, rupee weakness is likely to continue. So let's see how the crude does, because that looks much more bullish than the Nifty.
Okay. Yeah, I know. I have heard that Aramco theory as well. Ashwani, I think, has been doing the rounds for several months. Everybody's waiting for this gigantic IPO. Having said that, crude itself, I mean, as you see the charts, do you see 80 coming very quickly?
See, it all depends on geopolitics. Sometimes it'll happen faster, sometimes a bit slower. But shale gas is nowhere. I mean, I don't think this sort of crude rally would have happened if shale gas was coming online. So somewhere, supply cuts, etc., are working, and possibly in the next 2 or 3 months, you could have $80.
That's not too far away. Thank you very much, Ashwani, for being with us through the week, through the day, and have a great weekend yourself. For all of you who are watching, thank you very much for watching. Have a great weekend, and we will see you with the markets on Monday morning.